Hey everyone, welcome back. We're diving right into the thick of things today with a move by the Fed that, well, honestly, it's got people talking
It has.
and scratching their heads a bit. So, the Fed just cut interest rates. Quarter point. Now, I know what you might be thinking.
Yeah.
A quarter point, really, is that a big deal?
Right.
But the thing is, even small adjustments like this can ripple through the economy in unexpected ways.
hmm
So we're going to break down why they did it, what it could mean for things like economic growth and inflation, and we'll even touch on how this might affect your mortgage rates.
Right.
So first things first, can you walk us through the rationale behind this rate cut? What's the Fed hoping to achieve here?
Well, basically, they're trying to stimulate the economy, encourage people to borrow money, spend money. You see, there's this looming concern that we might be heading towards, well, a recession and this rate cut. It's a way to try and pump the brakes on that, kind of like a preventative measure, if you will.
I see, so a little nudge in the right direction.
That's
But one of the sources we're looking at today mentions that, prices are creeping up, especially for those everyday things we all need, like groceries, healthcare. That's a pretty clear sign of inflation rearing its head, isn't it?
Yeah, that's the concern. The Fed always has to walk this fine line between stimulating growth and keeping inflation in check. It's like a constant balancing act.
A tightrope walk, for sure.
Yeah.
And the source actually mentions core inflation sitting at 2.7% right now.
Mm-hmm.
So for folks who might not be familiar with that term, can you unpack that a little? What exactly is core inflation and why is that number making the Fed nervous?
Okay, so core inflation is a way to measure inflation, but they take out some of the more volatile categories like food and energy prices,
Okay.
because those can jump around a lot. And it gives them a more stable view of how prices are trending overall.
Okay.
And the Fed, well, their target for core inflation is to keep it around 2%. So that 2.7%, it's making them sweat a bit.
I bet. Even though 2.7% doesn't sound like a huge number, how does that actually play out in people's daily lives? Like, what's the real-world impact of that kind of inflation?
Yeah, so let's say your typical grocery haul each week costs you, say, $100. Now, with the 2.7% inflation rate, a year from now, that same basket of groceries, it's going to cost you $102.70.
Oof. Yeah.
Now, it might not seem like a lot,
Right.
but over time, those little increases add up. And basically, it means your money doesn't go as far. You're getting less bang for your buck.
Right, right. Your purchasing power is shrinking.
Exactly. So that 2% target the Fed aims for, it's all about trying to find that sweet spot, keeping the economy humming along, but also making sure prices stay relatively stable.
Okay, so they're already juggling this delicate situation with inflation, and then, like a curveball, we have a new president, new policies coming into play.
Yeah.
And the sources we're looking at, they point to things like tariffs, tax cuts, things that could potentially, as they say, pour gasoline on the inflation fire.
Exactly. It's true. These new policies, they kind of throw a wrench in the works because, something like tariffs. Well, when you put tariffs on imported goods, that directly raises the prices consumers pay. And tax cuts. Sure, they might boost spending in the short term, but they can also make inflation worse if the economy gets too hot too fast.
Too much of a gift thing.
Exactly. In fact, some economists are saying that these policies could potentially bump inflation up by a whole percentage point. So it's a tough job for the Fed, trying to anticipate these outside forces and adjust accordingly. It's like playing chess in the middle of a hurricane.
Oh, I like that.
Right.
Yeah, that's a great analogy. So the Fed's got this complex puzzle on their hands. They're trying to boost the economy, but without inflation spiraling out of control. And now they've got these new policies to contend with. And to make things even more interesting, we've got this whole situation with mortgage rates. On the surface, it seems logical that if interest rates go down, mortgage rates should follow suit. But that's not always the case, is it?
You're right. It's actually more complicated than that. Mortgage rates, they dance to the tune of a lot of different factors. You've got investor demand for mortgage-backed securities.
Yeah.
You've got the overall health of the housing market. And even global economic conditions can play a role.
Right.
Like, let's say there's a lot of global uncertainty.
Mhm.
Investors, they might get a little spooked and think, hey, mortgage bonds, those are pretty safe. And that can actually drive up the prices of those bonds and push mortgage rates down, even if the Fed hasn't touched interest rate.
Oh, so it's a lot more interconnected than we might realize.
Yeah, there are a lot of moving parts.
Okay, so let's take a minute to recap. We've got the Fed cutting interest rates to give the economy a little boost, but that comes with the risk of making inflation worse. And to make things even more complicated, we have a new president with new policies, and no one's quite sure how that's going to shake things up. And then there's the whole mortgage rate situation, which, as we've learned, has a mind of its own. It's a lot to take in, but it really highlights the complexity of the economic landscape right now.
It does, and it actually leads to a pretty fascinating question. What if you were advising the Fed right now?
Ooh, okay, I like this.
What would you tell them to do? Would you say, hey, cut rates even more? Let's really try and kickstart this economy, even if it means risking higher inflation? Or would you say, hold steady, Fed. We need to keep inflation under control, even if it means growth might slow down?
Yeah,
It's a tough call. There's no easy answer, and that's what makes it so interesting to think about.
it really does. I mean, today's deep dive has given us a lot to think about, all the factors at play, the difficult choices facing policymakers. It's a lot. But I think that's the whole point, right? To stay engaged, keep asking questions, and try to understand this complex world we live in.
Couldn't agree more.
So, to all our listeners out there, keep exploring these topics, form your own opinions, stay curious. We'll catch you in the next deep dive.
See ya.
Bye.
Bye.